All right, everybody. Welcome back to Data-Driven Investing. Sorry, I've been on hiatus for a while. We had the earnings, and then I went on vacation, and now I've been slammed at work and with family and stuff. So it's been a little while. I know this isn't the most timely information, but hopefully it's still useful to everybody for me to go over what I thought about SoFi's Q4 earnings. I'm going to break this into two parts, just like I'm doing with my article. So I'm going to cover the numbers in this one and kind of go into detail on each of the business segments. And then I'll do a deeper dive into the technology platform and kind of the vibes after earnings on my next video. So this is going to follow the exact same format as I did on my earnings preview. So we'll go through members, originations, the three different platforms, and then the actual numbers. And then we'll talk about kind of guidance. And then I'll add some thoughts towards the end, just on my overall impressions and other takeaways from earnings. So members, this was an awesome quarter for members. So SoFi set a brand new all-time high for members added. They had 785,000 new members added in the quarter. There were 31,000 churned members. So those were members who were removed from the platform in Q4. So net 750,000 new members. Members are the lifeblood of the platform. What is going to feed long-term growth of the company. And what's more, so the January data for website traffic actually is a new all-time high past that. So hopefully this isn't going to this increase in members will keep, or this increase in member growth will keep going up from here. So there's some good data kind of moving forward. Another thing, the customer acquisition cost for those members continues to stay relatively flat, just under $300 per member. And considering that each new member is bringing on more revenue as we move forward, especially in the financial services area, this is really positive, a really positive development, because the lifetime value of these members seems to be increasing while the customer acquisition cost is staying mostly flat. So we'll cover that in a second. Originations. SoFi absolutely killed it with originations this year, or this quarter. So the personal loans came in. I predicted that it would be about $4.5 billion of originations. They came in at $5.25 billion, inclusive of $1.1 billion of loan platform business. But historically, you can kind of see on this bottom chart, Q4 has always been a low point. So Q4 2021 was the lowest in 2021. Q4 of 2022 was the low point there. Q4 of 2023 was the low point there. That did not happen in 2024. In fact, it stayed much higher, almost to the exact same level as Q3. And you've seen in the other years, you've had a pretty significant drop off from Q3 to Q4. So this was much higher than I expected. Similarly, I expected less student loans because usually Q3 kind of gets a little bit of bump from in-school loans, but it seems like the end of the student loan moratorium and the starting of repayments that actually start to go on your credit report really spurred student loan refinancing this quarter. So I predicted a little under $800 million in originations, and they came in with $1.35 billion. And then similarly, home loans was also above my expectations. So Q4 is a bad quarter for home loan originations because people just don't move. But SoFi had the highest home loan originations that they've had since 2021. When rates were essentially at zero. So they seem to be taking market share in home loans. It's going to be a slow growth from here as rates come down. Same thing with student loans. But the fact that they're already outperforming where I thought they'd be is really, really positive. And then obviously just in personal loans, they're killing it. This is a slide I like to share that kind of compares SoFi to some of its fintech brethren who are in the personal loan space. So they're competitors. Lending Club is the green, Upstart is the red, and then SoFi is the blue. So you can see back in 2021, SoFi had by far the smallest market share of personal loans among these fintech competitors, and now they completely dwarf everyone else. So they're more than double what either Upstart or Lending Club is doing on their own. Upstart had a great quarter with a really, really high quarter over quarter increase. But overall, SoFi's added as many personal loan originations from like Q1 of 2024 to Q4 as Lending Club and Upstart have total originations in the quarter. So they continue to kind of gobble up market share in personal loans, which is great to see. So this is new data that I've never shared before, but this is SoFi's lending platform business versus kind of the competitors that they have in the same space. So Lending Club has a marketplace. Upstart, almost all of their loans are sold immediately to third parties. So again, the lending platform business, they originate these loans. They sell them within days or a week of having them, and they never take any sort of balance sheet risk. They automatically transfer that risk at the very beginning. And SoFi has no loss share agreements. So these are completely risk-free revenue and profits that come from this business. Lending Club has a similar business, which they call their marketplace, where they also originate and immediately sell those loans to third parties. And then, like I said, Upstart, pretty much all their businesses this way. They do have a small portion of their loans that they originate that they do take on their own balance sheet, but for the most part, they sell them on all. So this is all of Upstart's loans that they originate. This is just the marketplace loans for Lending Club. And then you can see, so starting just in third quarter, the third quarter is when SoFi started this business, started the lending platform business. In the third quarter, they had 1.0 billion in originations. In the fourth quarter, it was 1.1 billion. And you can see it's already double kind of Lending Club's comparable business and about half of where Upstart is right now. But they also announced in the quarter that they're signing a deal with Blue Owl Capital for up to $5 billion originated over 2 years. So that's about $625 million per quarter. So after they get that signed and after it's fully implemented, which probably won't happen until about Q2, but at that point they'd be at, call it 1.725, which is about this level on my cursor. So in just 2 or 3 or 4 quarters, they're spinning up a business that's already as large as Upstart's, or close to as large as Upstart's business, and they're taking absolutely no risk. Upstart, they actually have really large revenue loss share agreements relative to, well, they're just large in general, but I believe that Lending Club also does not have any loss share agreements with their marketplace loans. But this is something I want to track moving forward because I want to see how quickly SoFi is able to spin up this business and catch up to and possibly surpass Upstart moving forward. Okay, so deposits. I thought there would be $2.1 billion in deposits, demand and savings deposits. So that's checking and savings deposits. They call them demand deposits on the in the earnings material. And then a decrease in time deposits, which are also known as CDs. And that's exactly what we saw. So I was $10 million off. So there was $2.09 billion in deposits added. And this is a core reason for the fact that their net interest income is increasing. So one of the things that I wanted to look at and share is that many people say that the only reason that SoFi is growing deposits so much is because they're offering a high APY. And I want to just kind of debunk that. So even in November, SoFi was offering much lower APY than Lending Club. So Lending Clubs was almost a full 1% higher than what SoFi was offering. And yet, nevertheless, look at the fourth quarter deposits. Lending Club lost deposits in the first quarter, whereas SoFi, again, this is overall. So this is demand and savings deposits plus time deposits. But you can see they added, call it 1.6 billion in deposits overall, even while Lending Club with a higher APY is losing deposits over time. And in fact, Lending Club has had higher APY for over a year at this point. And you can see that despite them offering higher APY, they have never come close to the deposit growth that SoFi has. This is one of the things that they did highlight in the call. So I included this quote kind of on the bottom, where Noto said that the value proposition of SoFi Money is more than just the APY. This data that I'm showing you is backing that up. The fact that they have Zelle integration, the fact that you can do person-to-person payments, the fact that you've got, no overdraft fees, that you get 2-day early paycheck, that it works with everything else that's in the ecosystem, is allowing them to get higher deposit growth, even at lower costs than their competitors like Lending Club. Okay, so this was a driver, or that was a driver. The fact that they are getting deposits is a driver for net interest income, which you can see here. the expanding net interest, or they expanded both net interest margin and then obviously net interest income. In lending, they completely killed it. So I had thought that they'd get about 365 million in lending revenue, and I thought that would be driven by expanding NIM. In actuality, they got 423 million, and a lot of that was driven by, so it was driven by expanding NIM, but it was also driven by the really strong performance in originations that we kind of covered earlier in this video. Financial services, also a very strong quarter. So I predicted slightly higher than what they got. I thought they'd have 259 million in financial services revenue. I thought that the average revenue per user would stay flat. And I also, as we kind of covered a little bit earlier, I had my total member count slightly higher than what it came in. And so their actual was 256 million, which is still really, really excellent. And then finally, I'll cover this real quick before we get to technology platform. But this is the total revenue breakdown. You can see, again, the net interest income, which is cash in the front door every single quarter, is the bulk of the revenue from financial services. The green bar is the non-interest income. The reason that that's seen such a big jump in the last 2 quarters is that lending platform business. So we can expect to see both of these continue to grow as they continue to grow deposits in line with their asset growth, and as the lending platform business continues to grow, especially with that Blue Owl Capital deal. That should give them a nice bump as soon as it comes online, which we haven't seen any official PR yet. So we're still not sure if they've signed it, but it seems like they should have at this point. Okay, technology platform. This is not good enough. Again, I'll cover this more in depth in the future, or in kind of an article that I'm working on right now, and then I'll also put a video together to accompany it. The technology platform is disappointing, mostly relative to what they've said that they would achieve. So that's kind of my biggest disappointment, is simply that SoFi is a company that guides conservatively, and then they come out and they consistently beat that guidance. The only exception to that, since they've been a public company, is the technology platform. So this year they originally guided for significantly higher growth than they got. If you look at this data, it was only up about 6% in year-over-year growth. They wanted something kind of in the mid to high teens originally, and then they eventually said kind of the low to mid teens. 6% isn't even in the teens. Now that was for the full annual growth, to be fair, and not the year-over-year growth just for Q4. But I thought they'd be at about $112 million of revenue here, and they only came in at 102. Again, I'll be discussing this much more in depth in a future video. Corporate revenue, it is what it is. It came in roughly flat quarter over quarter. And so if you sum all those together, you end up with a total adjusted net revenue of 739 million. That's a pretty big jump, even quarter over quarter. We're looking at something like $45 million increase quarter over quarter. You can see both analyst estimates and their guidance below. This was actually the quarter where they beat their revenue guidance and they beat analyst estimates by more than any other quarter in the history of the company. So this was a massive beat on revenue, and it was driven by that lending outperformance. Overall, 24% year-over-year growth. And considering the fact that Q4 in 2023 was the quarter where they were doing everything they could to put up a profitable quarter, because they had promised that they'd be profitable in that quarter, and Wall Street didn't believe them, and they were. But that quarter was a really strong quarter, and to see a re-acceleration in growth from what we saw in Q1 and Q2, even with much harder comps in Q3 and Q4, is really exciting. And it makes me very bullish for 2025. On the adjusted EBITDA, so it came in at 198 million. That was an increase of about 12 million from quarter to quarter. I thought it'd be just under 190 million. So again, they beat my estimates, and analyst estimates were around 170 million. So this was almost a $30 million beat in adjusted EBITDA, which is also really, really high. Now, the year-over-year growth wasn't that great, only because, again, last year, Q4, they had a really, really high EBITDA margin. The EBITDA margin this year was actually less than last year, and a lot of that had to do with the way that they made sure that their expenses were lower last year to make sure that they hit that profitable quarter. But again, big outperformance here, really good quarter. So one interesting thing is, despite the fact that, I guess we'll go back for a second. So despite the fact that adjusted EBITDA went up by $12 million quarter over quarter, the net income only raised by about $300,000, so not even $1 million. So the reason that I have this kind of data up here on the right is, why is it that EBITDA went up so much and that net income didn't go up as much as you think it would, since those two move pretty much in tandem? The answer to that question is kind of in these cells that I highlighted. So these are what they call the reconciliations. This is the difference between the net income that they got, and the adjusted EBITDA. Okay, so these are all the different line items that they subtract from adjusted EBITDA to get to net income, or add in some cases. Now, again, in Q4, they had this really large income tax benefit of like $272 million. We'll talk about that more in a minute. But they adjust that number out of this. So the 60.7 million, or sorry, the 61 million is their adjusted net income. So it took out the one-time benefit of that tax benefit. But if you look at everything else, the biggest jump, so they had a slight increase in depreciation and amortization. That's to be expected as they continue to scale with CapEx. There was a slight increase also in share-based expense, but nothing too major. The biggest swing was in fair market value of servicing rights. So anybody who follows me and who has followed SoFi for a while knows that fair values, so these have to do with rates and the way rates move and prepayments and other things. But this is actually a non-cash expense item. And this is what made up the difference. So going from, call it -4 million, or 4 million added to the EBITDA, to about 5 million subtracted. So this was about 9 million difference between the GAAP net income and the adjusted EBITDA. And again, that's a non-cash expense. So it's not that particularly concerning. And it'll go up and down from quarter to quarter based on movements and rates and other things, but it's not a concerning thing to see. And I guess as EPS, so they did beat on EPS. They got 5 cents of EPS, 4 cents were expected. The full year was 15 cents of EPS, which is very, very positive. So moving on to guidance. Their 2025 revenue guidance, you can see here, I put a red dot, which matches my red laser pointer right here, where their guidance came in. These were analyst expectations. This is where they would need to be based kind of on their 2026 guidance. So call it 25% revenue growth per year. So this was much higher than analysts expected. It's a really good revenue guidance. The EPS guidance, I was initially very disappointed. So if anybody watched kind of our live earnings reactions, this was something we were trying to parse in real time, and I didn't quite fully wrap my head around. So I expected them to come in with 30 to 35 cents of EPS in 2025. Analysts were expecting 28 cents, 27 to 28 cents, somewhere in that range. And their guidance was only for 25 to 27 range, to 25 to 27 cents. I was disappointed at the time. I'm much less disappointed after going through all of the details that have to do with this. So we'll talk them through. There's 3 things that kind of are reasons for this. The first is taxes. The second is level of reinvestment. And then the third is their macro assumptions. We'll cover these one at a time. So I said just a minute ago that they did have this really big tax benefit. So SoFi has been an unprofitable quarter for most of their existence. And as you are unprofitable, you kind of build up a tax benefit that you can then take sometime down the line. So if you lose $100 million in a quarter, then some quarter in the future, when you gain $100 million, you don't have to pay taxes on that because you already lost it. And so this quarter, they took all of their tax benefit and they got it this quarter. So moving forward, I had assumed that they would, I knew that they still had a lot of tax benefit remaining. I didn't expect them to use in a quarter. So the tax rate I had built in for 2025 was around 8%. And I just got that kind of basically looking at these numbers from the last year or so, and then saying, well, they'll probably be taking less tax benefits into the future than they did in the past. So if it were an 8% tax rate, the 26 cents that they guided for would actually be 32.3 cents, which is right in the middle of that 30 to 35 cent guidance range that I expected them to give. So again, if you take the taxes out, they actually did guide for what I expected them to guide for. One benefit, kind of while we're talking about taxes, so SoFi gets that tax benefit, and all of those $270 million or so get added to their total capital. And because of that, and because they can have a ratio of about 15% of assets over total capital, that's the equivalent of being able to add about 1.8 extra billion dollars of assets to their balance sheet. So they can now hold another $1.8 billion of loans, whether it's personal, student, or home loans, on their balance sheet moving forward. So that's going to be a really big benefit for 2025. They can grow their loan portfolio and continue to grow that net interest income, both in terms of financial services and in lending moving forward. Which is something I don't think that I had built into my models or that most analysts did. So that's kind of the first mitigating factor is taxes. The second one is reinvestment. If you want to pause the video, you're welcome to and go through this. This is a quote from Noto from the earnings call. But essentially what he says is that back in 2023, SoFi kind of gave long-term guidance, and they said, what we want to do is we both want to be profitable and we want to balance that with reinvesting in the company. So their plan, as they set it out, was for each new dollar of revenue that they get, they want to reinvest 70 cents of that, and then drop about 30 cents of it. So reinvest 70 cents back into the business to grow it, to go into R&D, to start new products, to put into marketing, that sort of stuff. And then the other remaining 30 cents, they would drop to the adjusted EBITDA line. And so he said, back in 2023, that was the plan. In 2024, we pulled back on reinvestment a little bit so that we would be more profitable, but wouldn't grow quite so much because they took a conservative view on the macro. They wanted to make sure that they remained profitable the entire year. And so they didn't want to reinvest as much because they weren't sure about kind of the macroeconomic outlook and what would happen. And then he's saying, okay, but starting in 2025, we're going to go back to our 2023 levels, and we're going to be reinvesting 70 cents of every dollar back into the business. So that's why the revenue beat the analyst expectations, but the EPS did not beat it because they're not going to reinvest as much in 2025 as they did in 2024. However, that's a lie. So Noto repeated that. But it's a good lie because the reality is actually better than what he was saying. So he said that on the earnings call. He said it on the CNBC interview again. He said it on a Bloomberg interview the same day as earnings. And then he said it again another time at the recent fireside with Bank of America. But I have the data. And so you can see the data right here. In 2023, they never touched or even came close to an incremental EBITDA margin of 30%. So it's 48%, 43%, 48% again, and then 74% in Q4. So in 2023, despite the fact that he said that they were reinvesting 70 cents of every dollar, they were actually reinvesting much closer to 50 to 60 cents of every dollar. It is true that in 2024, they did take a more conservative approach. So you can see that incremental margins were above 50%, which means they were dropping more than 50 cents of every single new dollar of revenue to the bottom line. The one exception, again, was the quarter that was just reported, Q4. And the reason that this 12% is so low is only because this number is so high. That 74% made it so that, overall, over kind of 2 years, the incremental EBITDA margins averaged out. But this number was just so high that it makes this one look abnormally low. So if they actually go back to what they were doing in 2023, it means that that incremental EBITDA margins will be close to 40%. I don't think that's actually what's going to happen. I think that they'll probably reinvest more than that, but I do think that 30% is probably the bare minimum we'll see in incremental margins, and that there's room for upside above that, similar to what they did in 2023. Just that as they grow the business, they've been able to show quite a bit more operating leverage than they initially planned on having. if they did in fact initially plan on having 30% incremental margins. And I think you'll see that moving forward because, again, they are very fiscally conservative, and I expect them to outperform their guidance. Speaking of outperforming their guidance, so one of the reasons historically that SoFi ends up beating their guidance is because of they take a really, really pessimistic outlook on the macro. So this quote, again, is from Q4. It says, in line with market expectations, these are their assumptions for the macro. They think that the interest rate, that there's only going to be one or maybe two rate cuts in 2025, that the GDP is only going to expand by 1 to 2%, so between 1 and 2%, and that unemployment is going to normalize in the 5% range. So at the bottom here, you see the unemployment rate graphed. This is the unemployment rate since 2022. In 2023, they guided for north of 5% unemployment. In 2024, they guided for the end of the year being 5% unemployment. And once again, in 2025, they are guiding that at the end of 2025, we will be at the 5% range. The top of this range is 4.3%. So it's true that in 2023 and into the summer of 2024, it went up. But since then, it's pretty much leveled off. And the January numbers were actually much lower. So they were at 4.0% unemployment. This is a really, I love how it says in line with market expectations, because this is certainly not in line with market expectations, and I'll prove it. This is the Federal Reserve Board's estimates for change in real GDP and for the unemployment rate at the end of 2025. The Fed thinks that the US economy will grow at a rate of 1.6 to 2.5. So this is the total range of all of their members. So they actually think that kind of the midpoint of growth this year will be closer to 2%, which again is higher than SoFi's conservative assumptions. And unemployment, which I think is the most important if you were to rank rates, unemployment, and GDP growth in terms of what matters to SoFi, the most important one is going to be unemployment, because people who are employed pay back their loans, and SoFi's revenue and business relies on people paying back their loans. So the unemployment rate expected by the Federal Reserve, the most pessimistic member of the Fed Reserve Board thinks that we will exit 2025 with an unemployment rate of 4.5%. So SoFi, that's a really conservative assumption. And it's similar to the conservative assumptions they gave in 2023 and 2024. And we know in both of those years, they completely torched their own guidance, their original guidance during the year. This is to kind of give you a framework and to give me a framework for what might happen this year. I don't guarantee this by any means, but this is 2024's original guidance. So call it, $2.38 billion was what they expected for revenue, 585 million for adjusted EBITDA, and then their EPS, they said it would be between 7 and 8 cents for the full year 2024. Their actual numbers, they beat it by over $200 million. So they beat the kind of the midpoint of their revenue guidance this year by $217 million. They beat the midpoint of their adjusted EBITDA guide by $81 million. And then they beat the EPS by 7.5 cents. If they were to do that again, so let's say, hypothetically speaking, this is just hypothetical. If the unemployment rate stays low, and that's the main driver of their outperformance, and they beat this year by the same amount they beat last year, this is their original guidance that they just gave us. And if they beat by the same amount, this is where they would come in at just shy. So $3.45 billion in revenue this year, $936 million in adjusted EBITDA, and 34 cents of EPS. So this is probably closer to my own personal expectations for what they'll actually hit this year, rather than this guidance, due to the fact that they're just so conservative in their macro assumptions. While we're talking about the macro assumptions, so this is something that I kind of wanted to share. I think I'll probably just read it from my actual article, because I don't think that I can phrase it better than I did there. But so in my earnings preview, I talked about how they're PSUs might lead them to push extra hard or even be slightly more aggressive in 2025. And to their credit, they stuck 100% by their standard guidance methodology. So they built in conservative estimates, even though it might hurt the stock on kind of a longer term basis. Management doesn't seem to care about about the stock or how they can personally benefit nearly as much as they care about building a durable, long-lasting business that will grow and compound for more than a decade, regardless of the near-term consequences. And if I, as an investor, were to get mad or frustrated at the type of long-term mindset, integrity, and devotion to core values that I claim to espouse myself, I'd be a hypocrite. So that doesn't make management infallible, and it doesn't absolve them from criticism. And my next video and my next article will have a little bit more of that criticism in it. But I think this does make them very trustworthy, because if they're not willing to go above and beyond and maybe guide a little bit less conservatively, even though they have so much money riding on it, that means that they're people of integrity and high values. And so I value that a lot. And I'm a proud shareholder of the company because they espouse those virtues. And I think that that actually was something that I took away from these earnings, is that as impressed as I am with SoFi management from kind of an integrity perspective, I'm even more so this quarter, just because they didn't do what I thought they did. They weren't motivated by this kind of personal gain that I thought they might be. Final thoughts. So they did announce that SoFi Plus, the $10 a month subscription, and they've been pushing that pretty darn hard. So Wyndham Clark, Jason Tatum, and Justin Herbert, who are kind of all their celebrities, sports people that they endorse, all did individual videos about SoFi Plus. I think that they want to get people into the financial services productivity loop, and they see SoFi Plus as the way of doing that. So I'm excited to see how that pans out and see how many people, how much it pushes towards doing that and towards subscribing, whether it's through direct deposit or paying the $10 a month. And then finally, on the crypto side, there was one analyst question about it, and Anthony Noto said, as the regulation changes, we will be incredibly aggressive tied to crypto and be in as many businesses as we can be across the entire platform. Previously, we were just doing trading. You can see us go well beyond that depending on the regulation, including caching and clearing, trading platforms, asset-backed lending, and so many other areas. So we hope the administration and the regulators come up with clarity on what the outlook will be. We'll move as aggressively as anyone else once that is determined. I think that crypto could be a differentiating factor for SoFi, especially with millennials and Gen Z. That if they're able to do, for example, asset-backed lending on crypto holdings, that would be massive. And it would be really, really big for the platform. It would be something that other platforms aren't able to offer, that would distinguish them from their competitors. And again, I'm really excited. I hope that the regulation gets sorted out quickly so that they're able to do that. My next article and video, like I said, I'm going to do a deeper dive on the tech platform, kind of my thoughts on why it's been so disappointing, and also the kind of the post-earnings vibes. So during the time that I was on vacation, apparently plenty of people were melting down about what was going on, and there was a lot of frustration in the SoFi investor community, and some of it is certainly warranted, and I'll kind of talk about what I think is warranted, and some of the things that I think go a little bit too far. So thank you for watching. I know this was a bit of a long video, but hopefully you kind of take away a more holistic view of how earnings and my thoughts on them. You can follow me on X. You can follow my Substack. Thank you for all of your support. I will try again. I'm still catching up on my 9 to 5. I hope to get all caught up so that then I can do these more regularly moving forward. Thank you, everyone, and we'll talk to you again soon.